Hello, welcome to Business Finance. I just want to give you an overview of what business finance or financial management is all about. So, as we begin this course, it is the assumption that you took your first accounting class, and therefore you're going to see that your first accounting class provides the necessary information that we need to build on it as we move through the several chapters or topics in this class. So this course combines or borrows heavily from other disciplines. It borrows from accounting, it borrows from economics and other disciplines such as mathematics. In math, of course, we use statistical concepts, standard deviation, correlation, coefficient of variation. So we use those concepts, for example, to measure risk. So this course is going to emphasize on financial statement analysis, a time value of money, which is a very important concept in finance, management of cash flow, risk and return, and sources of financing, among other areas. But keep in mind as we go through this course, the primary goal of financial management is to increase the shareholders' wealth. That's the primary goal. Of course, there are other goals we were trying to achieve, but our primary goal is to increase shareholders' wealth, which is, of course, measured through the increase in the share price. So, just to give you an overview of some of the topics that we're going to try to cover, we're going to begin our discussion on the goals of financial management. Again, remember, our primary goal is to increase the shareholders' wealth, but we also have other goals or activities to be considered. Then we're going to move to chapter 2, 3, and 4, and those sub-chapters tend to focus on what you covered in your first accounting class. So we're going to review, of course, the balance sheet. We're going to review the income statement, the cash flow statement. Those are the financial statements or reports that you covered in your first accounting class. We're going just to review them. Again, remember, in finance, we're not preparing those documents. We're basically using what the accountants have done. So we're using the information from accounting to try to make some financial decisions. So we're just going to review just to give us an understanding of what is contained in those financial statements. And then we're going to take a step further by trying to analyze the financial statements. So we're going to do some computations in terms of ratio analysis, in terms of trade analysis to give us a clear picture, or additional information about the financial statements. And then we move a step further, even further, by looking at financial forecasting. So what we do in financial forecasting is we know that our normal financial reports they provide information of what has happened in the past. But what we're going to do with the financial forecasting is to try to again prepare or come up with the reports, the financial reports, but this way now we are looking at the future reports. So let's say, for example, we project our sales to go up. And we say if the sales goes up, then it's going to have an impact on the income statement. It's going to impact on the balance sheet. If that's the case, then we say how will be the new income statement look like, or how will be the new balance sheet look like. So that's what we do when it comes to financial forecasting. So we look at those scenarios. And then we look at operating leverage and financial leverage. Again, from an operating perspective, we're looking at our earnings before interest and taxes. This from the normal operations, what our earnings are, and how about if we can borrow? So if you borrow, of course, you have to pay interest, and therefore we're going to look at our earnings before, because after before taxes. But of course, after we have consider the interest element into those computations. So we look at that in when we look at the leverage, and then we look at current asset and of course the working capital, and we look at both the long-term sources and the short-term source of capital, and we look at the time value of money, which is going to be our foundation for this course. That concept again is a very key concept in finance because we use the time value of money concept to value securities or to value investments or to value assets or even to value debt. So that concept is very key to us. Then we're going to look at the cost of capital, which is basically the same thing of saying, the required rate of return. It's just it's whether you're a borrower, you're the receiver. So the required rate of return, remember, it's you earning a return on your money, but of course, whoever you spend becomes a cost of capital if you flip that side. And then we look at the capital budgeting decisions, the risk and capital budgeting. We look at how we value common stock, how we value preferred stock, and why companies use those two as sources of financing. We look at the dividend policy. If time allows, we're going to look at the dividend policy and, of course, the retained earnings in some respect. So this is some of the, just to give you an overview of some of the chapters or topics that we're going to try to cover. But keep in mind, this course is also going to build or bring some theories into play. So we're going to look at the capping model, the capital asset pricing model, and a number of other theories in finance. Because again, it's we're using economic theory and some theories to build on what we're trying to discuss in this particular course. So this is just to give you an overview. But the main focus as we cover the material, again, you're going to see risk and return relationship being a very key element for us. You're going to see capital sourcing and allocation in terms of where we're going to borrow money. Are we going to use short-term sources, long-term sources? Are we going to use where we're going to allocate? How are we going to allocate these funds? Again, that becomes an issue. Capital structures, as mentioned, we look at equity and the debt. How much of debt are you going to use, and how much equity are you going to use? And then, of course, is a way we can get what we call an optimal capital structure, where we say maybe debt is 40 and equity 60. I don't know. We're going to try to figure out if there is something or that exists, an optimal capital structure exists. And then we look at economics theory or economic information or concept, for example, inflation being one of them, and how inflation, for example, affects our required rate of return in terms of inflation premium, if you think from that perspective. Then we also look at how the economy is growing, or declining, whatever it is. Those are the economic issues we have to try to consider when we're making, financing decisions in business. Required rates of return for capital budgeting decisions, and of course, the cost of capital being also another key element that we're going to try to address in this particular course. So keep in mind, this is a summary of some of the issues that we're going to discuss, but I hope that you're going to enjoy this course and you're going to find the course more interesting and more fun, just because again it's a multidisciplinary. It borrows from other disciplines, and hopefully you'll find that interesting as we go through the course. So let me know if you have any questions, and I look forward to working with you in this semester. Thank you.